Well, here we go. Installment number one of maybe we're going to have, well, many of them, at least 6 of them, perhaps as many as 10 of them, in the local versus offshore challenge. What happened was one of the BizNews community members said, "Here's R1 million. I want to put 500,000 Rand with a local champion and 500,000 Rand with an offshore champion." And Piet Viljoen has been looking after the local money, Magnus Heystek looking after the offshore money. And maybe, guys, before we start, I'll just bring you up to date with something I mentioned in an email. And that was many, many, many years ago. We had a syndicate from my old university friends at KZN. Of course, the colors of the horse were black and white. And that horse was called Coin Mistress. It was the fastest thing over 800 meters, but it never ever won a race. Now, Piet Viljoen, it's like you, the Coin Mistress of this challenge. You're just way in front of Magnus at the moment. Maybe just unpack it a little bit for us, Piet, why your investment strategy has been so superior to the offshore one for the first 6 months. Remember, we're only 6 months in.
Yeah, so I think that's first point is that we are 6 months into a 5-year race. So I think we've probably done, we haven't even done 200 meters yet. We're not even close to even the 800 meter point of the race here. Very early days. And yes, and the other point to make is that this is real money. Your BizNews community member has actually put 500,000 Rand into a fund which I manage, the Counterpoint Value Fund, and 500,000 Rand into a fund or funds that Magnus recommended. So this is real money on the line. It's not a paper portfolio or play. This is real, and this is happening in real time. And so far, the returns from the South African market have been fantastic over the past 6 months. They have been very good, and they've actually been very good over a number of years now. And our assets remain cheap. And I think the important point to make here is that this is not a bet on the success or lack thereof of our government and implementing its policies or changing its policies to make it more market friendly. It's not a bet on that. It's a bet on the second derivative of that. In other words, I'm saying that our assets discount a very negative future, more negative than the reality will be. Because, even with the best will in the world, it's very hard to imagine with our incapable government a very optimistic and rosy scenario for the economy and the country. It's very difficult. But our assets are imagining an even worse scenario than is the most likely outcome. And as long as they're priced that way, I think my view has been for quite a while now and remains that in any investor's portfolio, a portion of it should be allocated to South African assets. Not everything, not all of it. I think that would be irresponsible, but at least given current pricing and current expectations embedded in asset prices, I think at least a portion of your assets should be allocated to South African assets. And that's, I think, where that was the genesis of this bet that we sort of taken 6 months ago, or that your community member initiated 6 months ago.
Going back to the Coin Mistress analogy, if it's a 1,000-meter race, which is about as far as she could ever manage, then we've got 200 meters. We won not even 200 meters through. Yeah.
It's barely started.
So we just out of the starting blocks. You out like a rocket. His 500,000 is now worth 590,000 Rand, 679. So it's up 18% in the last 6 months, which is phenomenal. Magnus, that 500,000 Rand that the community member entrusted to you is now worth 356,000 Rand. So it's down 28%. Are you worried that you're so far behind just after the jump? It's almost like you were left in the starting stalls here.
I've not only been left in the starting stalls, I think my saddle has fallen off and I've got to remount and I'm going to chase Piet Viljoen, who's on a winning streak next to none. You've got to understand, Piet has been on a great winning streak for a long time now and is doing exceptionally well. The one thing that I could not control of this challenge was the timing thereof. You know, the BizNews community member came forward in October, November last year and said, yes, 500,000 each. Do you want to take up the challenge? And we both took it up, bearing in mind we were very, very close to the end of a fantastic bull run in offshore markets, S&P 500, Nasdaq, FANG, etc. And I've sent you a graph to show how significant the outperformance was. And for the first month of this little competition, that still continued. But then December, January happened, and now we know, in the investment world, you've got to expect the unexpected. But what happened was a multiple unexpected things that happened. You had, first of all, the sell-off in the commodity, not only commodity stocks, but in the high-tech stocks, the mega trend stocks, FANGs, were sold off brutally. Secondly, you had the Federal Reserve's higher interest rate policy starting to affect the larger fund managers. And then you also had the strengthening of the Rand. And all those things came together at once from all different directions. And my portfolio was slaughtered on all fronts. But it is still alive. And, I'm not going to do what a lot of people are inclined to do in these times, react emotionally and start selling and panicking. We always tell people stay in the market for a long term, and I'm not going to break that rule. I will make some adjustments and over time. And I've taken my knock. There's no question about it. But that's just the nature of the markets. Whereas Pitts, with his value style, has done exceptionally well, and all kudos to him. But it reminds me of, you use your horse as an example. It reminds me in 1999, there was this young golfer who came and played in the US Masters for the first time. He had won every single amateur champion that was possible. He was rated the best golfer of all times, and he played the first round of the Masters in 1999. In his first round, he shot a 4 over par 40, and everybody said this boykie it was all hype and overblown. And he came back and he shot from there on. He went on to win the US Masters by 12 shots, despite the fact that after the first 9 holes, he was about 6 shots behind the leader at that time. And I feel like a little bit like a Tiger Woods, who had a terrible first 9. But I will continue to come back and see what I can do. I must say there's a hell of a big gap between Piet and myself. But this is the lesson in investment markets. Markets change all the time. And you can do the best planning in the world, and you can have the best argument that you've made for your portfolio or your approach to your portfolio, and something will come from the left field and it will give you a clap like none. And that's what's happened in the first quarter. So there's a touch of humility in the Heystek household at the moment. I'm working very harder, but I can already see signs that the reports are coming through. Now is not the time to sell. Goldman Sachs this morning put out a report that some of the FANG stocks are looking very attractive, and some of the tech stocks are starting to look attractive, and even the S&P is starting to look a little bit better. So investment is a long-term game. Put your emotions aside. And if you are wrong, sometimes you must change your viewpoint on markets. But this is going to be a very fascinating challenge, competition with real money. And I think we all will learn from this. I've certainly already learned that, I missed a couple of tricks. Piet got his call spot on, but there is still 4.5 years to go. But so far, well done, Piet. Your bottle of red wine is on its way.
Just to throw something at both of you, one of the lessons perhaps could be to stagger your purchases. What we do in the BizNews portfolio is whatever we buy, we only buy it over 3 months. Now, that was brought in the initial stages because we're talking about Rand and we're talking about individual share prices, which can move all over the place. And I was trying to say that it's a good discipline not to buy everything today, but to stagger it over 3 months. In your case, presumably you guys invested 100% of the allocation. That's 500,000 each 6 months ago when it came in. Piet?
Yeah, no, it went in day one. It was invested in the Counterpoint Value Fund, and the results since then have been what the fund has done. The money in the fund has done. And that's what we did. I think that there is some validity in that way of phasing your money into the market if you're unsure as to exactly what level you want to buy at. I think the other point to make here is that this little race we've got here between offshore and onshore is also unrealistic. I think any investor would run a diversified portfolio. You wouldn't have either or. You wouldn't have everything offshore or everything in South Africa. It's not a case of either or. It's a case of how much do you allocate to different assets. And my argument has always been that in a diversified portfolio in the current times that we are in, given current valuations, you would allocate slightly more to South Africa than you would have maybe done that then is your neutral position. And if your neutral position is naught, then you put a little bit here. If your neutral position is 20, you put 25, whatever you just weight it slightly in favor because of the valuation argument. So, and it goes back to that thing I think I tweeted it during the week this time. You either believe that you can forecast the future or you believe in diversification. Now, I know I can't forecast the future. I don't know what's going to happen with markets or anything. And therefore, I believe in diversification. I think that's a sensible strategy for any investor to follow. And Magnus does himself with his clients. His firm is an investor in the Counterpoint Value Fund, despite his strategy of investing predominantly offshore. He has allocated some of his clients' capital to the Counterpoint Value Fund, and I think correctly so.
Magnus?
The difference between Piet and myself. Peter's a fund manager. He has to deal with money, funds in front of him. We're a firm of investment advisors. We deal with people first and foremost. And that's always the starting point as to how much we allocate to any asset class. And if we don't do our homework in terms of risk profile, period in the market, and tolerance to risk, and sometimes the ability to take risk, we cannot do that unless you've done your homework. And there's no question that there are some investors who must not be invested in the offshore market, and we repeat that endlessly. We say to people, if your situation is of such a nature that you have limited capital, that you have income requirements rather than anything else, you cannot go to the offshore market because it brings in a lot of volatility in the short term if both the rand and the markets go against you, as they happened in the first quarter this year. On the other hand, we have much more wealthier investors who have their needs taken care of, the income is paid off, they've got absolutely no debts. They tend to have a much larger exposure, in some cases 100%, some cases 70%. But you cannot just make a statement, everything must be offshore or onshore. It depends on the client and a lot of other factors that we have to take into consideration, and which we do. In this case, it was, we went in immediately. We wanted to get the money to work. And as I said, the first 5-6 weeks, it was doing fine. And then we had January, it was like someone had switched off the lights. The markets just went into a tumble dryer like I've not seen in 30 years in the markets. It was just, everything was just so dear Makar. Nobody actually knew what happened. And, things will change. We have the Federal Reserve making statements today. Tomorrow, we also have the war in Ukraine, which nobody really predicted. And it doesn't help markets, especially risk assets, when you have a president of a country every 3 days threatening the nuclear option. I mean, that scares markets, in my opinion. That scares people. And this is the stuff that we have to deal with. We have to deal with the human reaction to these kind of things.
I heard it described recently that equity markets deliver superior returns because it rewards you for seeing through the volatility. In other words, if you get panicked when everybody else is panicking, either when they're buying or you get excited when you get excited when they're buying, or you sell when everybody else is panicking, that is going to punish you. But if you can just be tolerant and you can somehow protect yourself from becoming emotional, then the market will reward you. So if you stay over a lengthy period, is that something, Piet, that you would agree with?
Yeah, I agree with that. In Afrikaans, we've got a word called fastbite. I think the market rewards fastbite. I think if you have a strategy, and a strategy based on a sensible set of expectations and a sensible way of constructing a portfolio that includes diversification, then I think you should stick to that strategy, no matter what the market throws at you. Because in the short term, the market is a voting machine, and it just, it does, it's just whatever most people do, or buying or selling, that's where the market goes. But in the long term, it's a weighing machine, and it weighs earnings and it weighs cash flows, and it puts a value to those. And if you can stick with those sort of things, the market will reward you. But it will, in the meantime, is going to do its best to throw you off course, because that's what the market wants. It wants to go up with the least amount of people on board, and it wants to go down with the most amount of people on board. So, the main thing to do is to stay the course, have a sensible strategy, speak to your financial advisor, people like Brenthurst Wealth, speak to people like that, set up a proper investment strategy and stick with it. That's the important thing, stick with it.
Do you find this is your major message that you give to your clients, Magnus?
Indeed it is, Alec. We spend a huge amount of time with clients asking a heck of a lot of questions about themselves, their personalities, their family situation. And it's a very, very thorough. I'm not trying to brag what we do, but before we come to a conclusion, we've spent a heck of a lot of time. And based on our experience, based on what Peter's just painted, we advise clients, this is the strategy we recommend. It's no guarantee. There is still the uncertainty in the markets, but that will give you the best chance. And fortunately, I would say 95% of our clients buy into that methodology. We cannot go around and guarantee this or punt that market. This is the next hot thing. Nobody can do that. There are people who do that, but they don't last long, Alec. And the point that Piet makes is, if you look at history, look at the returns, historical returns of any major index. It can be S&P 500, it can be the JSE. Time rewards the patient investor. At some point, the market becomes very cheap, like the South African market. And as Peter just said, we've been a great supporter of his Counterpoint Value Fund because it started doing well. We analyzed it. Whereas in the past, we had criticized the performance. We're now openly supporting it because it's his time. But of course, we cannot put everything into one fund or with one investment style. So we try and spread it amongst fund managers with different styles. And that's the only sensible way to manage money. It's not a casino. It's not everything on black and hope it turns out to be correct.
So if our community member had said to the two of you, okay, I don't really want an offshore versus local challenge. I want you to manage my portfolio as rationally as possible for 5 years. Piet, how much of it would you have put into the local market, which, as we now know, has performed incredibly well in the first 6 months, and how much would you have put offshore? In other words, how much of that 18% return that you've achieved would you have sacrificed in the interests of greater diversification?
So I do happen to manage a fund that does that invests anywhere in the world, and that fund at present has about a third of its assets in South African assets.
So it's as much as that. 2/3 would be offshore.
And I would regard that as quite high, yeah.
So if that was the way that you were managing the money that the community member had given you, it would be pretty flat then at the moment. If if my arithmetic's close to right.
In rand terms, remember that the investment style of the fund is value. So even the offshore assets are value driven. And they've done fairly well. So it would be up. It would be up.
Magnus, how would you have handled it if you were given that mandate?
It would approximately be around the same figure. And as I said, there's no right and wrong answer. Some of our clients have got zero and they're all in income funds or very low volatility equity funds because that's what they need. other clients who intend to immigrate in 3 or 5 or 10 years, they're comfortable with 80 to 90% because they need to price their future expenses in the currency where they're going to end up. And you start preparing for that eventuality. You don't want to run the risk where someone is immigrating and you build up all of his assets in rands, and a month or two before he immigrates, the rand has an almighty crash and wipes out 30% of his currency. So again, it's based on client to client. There's no one rule that one can say it's a 70-30 or an 80-20. It doesn't exist. It depends on the client. And it also sometimes depends on markets at the time that you make these calls. Markets also, you kind of have a good feeling this market is overvalued, that one's undervalued, these are the risks. But as Pete says, nobody knows the future, but there are a couple of intuitive paths that you follow. Don't overexpose to one asset class because it can burn you very badly.
Closing off with, how are you seeing the next 6 months? When we talk in 6 months' time, do you think that gap is going to be narrowed, Piet?
I wish I knew. I can't say. Look, the gap is quite extreme at the moment. I'd be surprised if it didn't narrow. How much I wouldn't be able to say. I remain convinced that our assets are still cheap. They're still discounting a future which is way worse than what actually lies in front of us. So I think there's upside. However, having said that, I think the global environment is fraught at the moment. There are all sorts of problems, not only political, but also, I think, financial problems. The very strong dollar and the very weak yen are sort of canaries in the coal mine of issues out there. So I think we can be in for possibly a tough while. But how do you play that? You sell everything in now and go into cash, and maybe it doesn't happen. It's you can't really play that sort of game. As I said, you either believe in forecasting or believe in diversification. I believe in diversification. So the way I manage my funds is to not take a big bet on a future outlook, but rather to play the cards that are dealt in front of me and just allocate towards cheap assets, however, wherever they may be.
Magnus, can you manage another half year like the one that we've just seen?
I doubt it, Alec. It's been very, very tough. I must say, it's been quite traumatic for not only financial advisors, but also for clients, especially those clients who went into offshore the last 6 months of last year. They have unquestionably suffered nasty, nasty losses. And we spent a lot of time almost counseling them and saying, do not panic. You went in for the good reasons, 5 to 10 years. And I can say, perhaps with the exception of one person, nobody has said, bring my money back. They're not doing that. We are making adjustments. It seems like the value fund or the value style fund is starting to come through. So we are acknowledging that and making changes and looking for good global value style managers so that we can reduce the risk in the portfolio. But cashing it out is absolutely it's no option. I must remind you of 2 years ago in the middle of the COVID crisis, in fact, 19th of March, when the market bottomed. I mean, if you had pulled out your money in a state of panic, you missed out on one of the best bull markets in a very, very long time. The market's been up by 70 to 100% in the 8 months thereafter. So making adjustments, spending more time, you can always make adjustments on other sides of the portfolio to build up cash to last you longer. That's the role of an advisor, and that depends on client to client. I mean, cash has given South African investors a phenomenal return. And I'm talking about things like Pete's Counterpoint enhanced income fund. I think the returns over the last 10 years was something like 8 to 8.5%, beating most equity fund managers over a 10, 7, and 5, and even the 3-year period of time. That's where we found refuge and solace for our clients in very nice, predictable, enhanced income funds. The volatility was always on the international funds.
So right now, the local fund is way in front, but it's only 200 meters of a 1,000-meter race that we're into. We look forward to the next installment.